Hello again, here we are at the end of the financial year, and it's generally a good time to review where we're at and tracking along. The key points that we're going to talk about today: how far away is a US recession? A recession is generally triggered by three factors coming together all at the one time, and they are the increasing cost of money, inflation, and a geopolitical influence. We're also going to look at China almost slowing to a halt. And with that softness, that's feeding through to emerging markets in Europe. Based on all the data before us, the US is still showing no sign of a recession in the next 6 to 12 months. Political sentiment generally doesn't lead to any meaningful correction in markets on its own. In 2015, China was threatening a recession. In 2016, we had Brexit. 2017, we had the North Korean threat. And in 2018, we had the Trump's trade war, inflation, and a threatened bond crash. None of these factors have emerged into a serious trigger for a bear market. So without any further delay, let's hear from Chris at Longview Economics in London.
Welcome to Financial Choice clients. It's lovely to be speaking to you again from London in the middle of June. We're in the thick of Brexit shenanigans at the moment. Our Parliament are voting on all sorts of amendments and all sorts of dark art of politics at play. But I have to say, I don't think it's terribly relevant for global markets or global financial prices or even the global economy. Indeed, it's limited in its relevance, I think, even to the UK economy. Yes, it's a bit of an issue, but the UK has much bigger issues than that. But what it does, of course, is it highlights the politics that's at play in Europe and the challenges we have at the moment. It's not just the UK, of course, it's also Italy, whereby we see a coalition government just getting into power in the last few weeks or so with policies that are really anti-European institutions and likely to cause all sorts of problems. Markets, though, given such widespread liquidity, have shaken off those initial fears for now. What's more interesting, I think, in the world of global markets is the monetary tightening that's underway. And indeed, in the last 24 hours, we've had the two of the three biggest central banks in the world pronounce on monetary policy. The Fed last night, UK time, and the ECB really in the last hour in the middle of the day today. Both have been probably at margin a little bit more hawkish than people expected, particularly the Fed, whereby they priced in a fourth rate hike for 2018. They moved to press conferences after every meeting from next year, and they did one or two other technical things that highlighted their slightly hawkish and confident bias. Some of the language is very strong about the outlook for the US economy. And then, of course, over to Europe, the ECB have also been put in place plans to reduce their balance sheet expansion and indeed end it by the end of 2018, reduce it over the fourth quarter of this year and then end it by December, assuming all is well. Now, what's interesting is they've got the same sort of bias and direction of travel in terms of the central banks, but we think the economies are on very different trajectories. The US is strong and remaining strong. Growth could be as over 4%. This quarter, in the second quarter this year, we're pretty much done in terms of the data that needs to be collected for that. It's looking very impressive. And in contrast, in Europe, in the Eurozone, we see a distinct slowing in the data. Monetary indicators are slowing. There's a clear indication that the European banking system is not really standing terribly well on its own 2 feet. Unlike the US banking system, where the money creation amongst commercial banks is working well and working without the US's QE program. In Europe, it's the reverse. As QE has slowed over the last 6 or so months, monetary metrics have slowed as well, indicating the banking system isn't really delivering the way it should be delivering now. That's important because that basically underscores and feeds straight into our key global macro theme and then into our global asset allocation recommendations. But the way it feeds into that global macro theme is what we've been talking about pretty much all year, the shift of global growth leadership away from sort of broad-based global reflation that we had in 2016 and 17 and towards US driving global growth, and that I think is playing out, and we're seeing that in the economies of Europe and the US and also in China, where I think the economy is much softer than people realize. And of course that feeds straight into our view on the US dollar, which we think will continue to strengthen. We think that trend is just beginning over the course of the last few months and will persist for many months, indeed maybe many quarters. And I think feeds into one's global asset allocation view. Strong dollar. I prefer US equities. The bull market is alive and well. US corporates are in terrific shape, despite all this chat about high corporate debt levels. That misses other pieces of the corporate balance sheet puzzle. And if you add it all together, the corporate sector is actually in pretty good shape and looking good, throwing off free cash flow, and not with high net debt levels once you properly adjust for them. So we like the US, we like US equities. We think the US market will lead the global bull market, technology within that. And we're getting increasingly concerned about what we see in the Eurozone and a little bit cautious about what's going on in China as well. So that's the update. The bull market's alive and well. The US is leading it. That's the place to be, I think, for now. Thank you very much. Have a good month. We look forward to catching up again in a month's time. Thank you.